Welcome back to the Real Estate Standard Podcast, episode 21, where commercial real estate and Bitcoin collide. I'm your host, Tim Kotzman. Today is May 26th, 2026. I'm here with Kenny Alves and Chris Drizga. Each episode, we break down how serious operators, investors, and developers stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin. On today's episode, we have Wyatt O'Rourke with Basilic Financial. He's also the author of Bitcoinization of Finance. And of course, first, I'm going to hand it over to Kenny to give us an update on Westmain Storage stacking. Kenny, over to you.
Hey, Tim, thanks. As of today, May 26th, we hold 14.62 Bitcoin. So that's 1.46 billion Satoshis. So far in 2026, we've stacked 12.4 Bitcoin, 1 billion sats, and we've achieved a Bitcoin yield of 568%. So what does that mean? That means that we've 5x our Bitcoin stack since this January, which is exciting. So we're growing, and our Bitcoin per square foot is at 21,060 Satoshis, and we're approaching Bitcoin per square foot parity, what I like to think of as all the Bitcoin that will ever be 21 million divided by the current amount of commercial real estate in the United States, which is 97 billion square feet of US commercial real estate approximately. And so that number will go up, and the Bitcoin per square foot parity number will go down, but it's currently sitting at 21,649 sats per square foot. So we're approaching that level. We're 600 sats per square foot away from achieving that milestone, which is pretty important to becoming a dual asset class. Our Bitcoin holdings now cover 4 years, a little over 4 years, 4 years and 13 days of coverage. And our NOI has increased by 115,000 a year since we've added digital credit, digital rents to our balance sheet. We have $1 million of stretch, a little over 10,000 shares, and that is going to increase our NOI by roughly 15% compared to last year's rent. So it's real money. It's that we might get a little pushback if calling it digital rents, but that's what we think it is, because it's unlocked by you have to have a commercial property or a piece of real estate that you can pair it with to get the full effect, to get the tax benefits. Our next payment is expected June 1st. That's going to be $9,583 for June 1st payment. And Chris, I know you asked last time, so I made sure to do the calculation ahead of time. That's the equivalent of 33 climate-controlled storage units. So we're able to scale right when we obtain the capital. Once we raise the money, once we generate some revenue, we can deploy it in real time to grow our facility. So we have 477 physical storage units, and now we have 33 in cyberspace, pushing us over 500 units. And so that's why we think of it as digital rents, because it's we're looking at it from a real estate operating lens. The key difference here is that it's 100% profit margin and it's tax deferred, opposed to ordinary rental income, which makes a huge difference after tax. And that's where operators really like to focus on. Banks and other financial institutions, they kind of overlook the after tax ramifications, right? They're more concerned pre-tax. So this has been a game changer for us. And then I just wanted to let you guys know that we made some updates to the dashboard. We got some new sections here. We got the solar, we got the API plugged in, so we can see the 2 solar arrays. generating energy, and you can break them down into the first one and the second one. And the first one here eliminates our electric bill, its self-consumption, and we can estimate the lifetime value of that power here in real time. We can see today we saved about $81 not having an electric bill here. And then you could flip over to the second solar array, which this one is selling the energy back to the utility grid. Today it's generated about $169. This is the income that we convert into Bitcoin, right? So when we DCA every week, we just had a DCA today, that I went over, and this is where the money's coming from. It's coming from the solar energy. It's coming from the digital rents. It's coming from the ordinary rental income. And we got a debt tab now, so we can see the total outstanding debt with currently, we're working through a refi, so these numbers will change. But currently we have, if you look at our three, our mortgage and our non-recourse loans, we're up to 5.8 million. You can we're just trying to be transparent here, showing all the different forms of debt that we currently have on the property. And this is the all tab that summarizes everything. And you can see the cumulative NOI with the solar, with the ordinary rental income, with the stretch digital rents. And so got some cool new charts here with loan to value, and you can play with it. You can remove the stretch or the digital rents or the solar and kind of see where you're at. This helps us kind of just see where we're at. And if we look at it just from rental income, or if we add the solar in and see what kind of impact that has to debt service coverage ratio. So we got some cool new toys to play with and keep track of our debt and our income, and see how that breaks down, like how much is coming from solar, how much, and this just gives us kind of real-time dashboard, quick insights into the company. So I know that's a little longer than normal, but Chris, what do you think?
Boys and their toys, man. Give us a dashboard and some cool neon colors, and we're good to go. No, this is awesome. I mean, just to be able to visualize some of the different components here, and ultimately the optionality, right, that we've been talking about each week, that we're building out here, I think is incredibly exciting and a very powerful visual demonstration here. You said a couple things there. One was 4 years of mortgage coverage. Did I hear that correctly, Kenny?
Yeah, let's go back and get the
4 years,
13 days.
coverage. Just think about that in the context of a typical real estate cycle. Historically, a real estate cycle is 5 to 7 years. So if shit totally hit the fan, right, you're going to be able to weather this downturn a lot better than any of your competitors, right? Full stop. So that one was really interesting. Seeing the Bitcoin per square foot parity metric start to come into vision is really cool as well. 97 billion square feet of commercial property in the United States, like that's all property types: retail, apartments, storage, office, industrial, and it's expanding every year. So that metric is obviously just a kind of a snapshot, and in a point of time here, it will fluctuate. But you're going to get to a point into the future where, whether it's an individual property or a broader portfolio, they're going to be valued in Satoshis or valued in Bitcoin. And the few operators that can, raise their hand and say, hey, we meet or exceed the Bitcoin per square foot parity metric, they're going to be some of the most sought after properties and investment vehicles in the entire industry. So congratulations again, Westmain. You're blazing a trail here and doing it in real time. I love it.
Could you take me over that metric again? The Bitcoin per square feet parity.
Yeah, so if you look at all the commercial real estate in the United States, it's approximately 97 billion square feet of real estate. And then you're just dividing it by the 21 million cap on Bitcoin. There'll never be exactly 21 million, just right under it, right? But we all use the 21 million. And so if you do that calculation, you come out to like 21,680 or whatever it was. And that's what you need to have like your share if you're looking at it through a real estate lens. Obviously, it's, there's a whole world of other assets out there, but if you're just looking at it from commercial real estate, that's kind of your target, where you would like, where I would consider your like a true like dual collateralized asset, where you have both the Bitcoin and the real estate 1-to-1. And I think like over time, like if like Chris said, like if you have like a 1-to-2 ratio, like if you have a multiple, if you have like 2-to-1 rather, and you're over collateralized now, you're 2-to-1 Bitcoin, you're in a much stronger position, because you can weather any kind of financial storm. You could do a whole renovation. You could tear down the building and you could rebuild it, and you have 4 years to rebuild it before you'd have to worry if you wanted to do some great kind of transformation. But it's all about the optionality, right? Like you have all this capital backing your real estate. And the other thing, like, I'm not not financial advice, I'm not a CPA, but like, when you sell a company, there's different tax ramifications than when you sell Bitcoin. So like if you're selling a company and the company owns the Bitcoin, you have a dual collateralized asset, is what I like to think of it as, and that's going to have large benefits in the long term.
Certainly, no, that's awesome.
Wyatt, I'm really excited to have you here today. Appreciate you making some time. I'm really excited to get your thoughts on what we're doing here. I mean, Wyatt was actually, Kenny, he interviewed me back in, I think, February at the Heat Punk Summit up in Denver. And he was the moderator for our panel, and it was 4 of us in the real estate industry, all kind of operating in a couple different areas. But I had alluded to, just very briefly on our panel, some of the metrics we were developing to measure the economic performance of the real estate asset in Bitcoin terms. Satoshis per square foot was one of them, and now this Bitcoin per square foot parity metric is another one. Obviously, we got Bitcoin yield. So we're developing and testing a lot of these things out in real time. So it's it's exciting, but it's also very fluid. In the same breath. But I'm excited because I want to know what financial planning is like when Bitcoin is the foundational asset, right? How does the conversation change? How does the decision-making process change? And, there's very few of you out there, Wyatt. So you're blazing a trail in your own right.
Well, thank you, Chris, and I really appreciate you guys having me. It's an honor to be here. I've been following along closely on Twitter, and I'm honored you saved a very special guest for episode 21. Thank you for that. It's very kind of you guys. So I started Basilic Financial. We're a Bitcoin-focused wealth management firm. We're state registered, RIAs here in Colorado. I do actually have a little bit of real estate experience. It's certainly not my topic of focus now. I'm a Bitcoin maximalist, but still have some appreciation for the asset class. And I started Basilic after my little real estate endeavor. Had a different startup that went bust, and I knew at that point I wanted to start a Bitcoin company, but I couldn't code or anything, and so I just took like the RIA business model and made it Bitcoin native from the start. And kind of our brief elevator pitch when we're working with Bitcoin clients, specifically in the financial planning aspect, is I've stacked sats, like now what? Like we help them with the now what side of things. And something I hear all the time is like, I have Bitcoin, I don't need a financial plan. It's like, well, that's the wrong answer. Bitcoin is money. Clearly you can do things to hurt your Bitcoin appreciation, or you can do things to help your Bitcoin appreciation. And I'm obviously biased, but I think Bitcoin financial services is one of the most exciting sub industries of the ecosystem to be in, because you have this traditional finance playbook that just needs to be applied to Bitcoin. And so where I sit from the advisor seat, it's super exciting being able to offer things like Meanwhile, Bitcoin denominated whole life insurance policies to clients. Something we've been looking at a lot lately are products like Savannah or Horizon. A client may have idle home equity. How can we tap into that to stack more Bitcoin? So we're really trying to level up our game and play off the other great entrepreneurs in the space that are developing these products, because ultimately it helps me and it helps our clients. I would say my clientele probably skews like a little bit younger than your standard financial advisor, but quite a few of them still do own homes. I have a couple of clients that are in real estate more heavily on the institutional side, either like LPs and funds, or have like multiple rental properties themselves. And the reason why I say I'm a Bitcoin maximalist, but I'm not a real estate hater, is I kind of think of real estate for the longest time was the most scarce asset the average Joe could get their hands on, right? And so it kind of fits into kind of that core tenet of Bitcoin, of being scarce, and I'm saving my wealth in asset class that is much less likely to get debased than in a money market account or whatever. So I'm sympathetic to that cause and why people do invest in real estate. I think it's created some disparities between the utility value of a lot of at least residential real estate and the monetary premium on top of those right now. But maybe we'll get into that later. So when I'm working with clients and looking at their real estate portfolio, a lot of times, especially compared to Bitcoin, so it's like, okay, we're working with this scarce asset, right? But it's so much more bulky than Bitcoin. If we're going to sell a property, there's broker fees and real estate agents, and it's like all these different counterparties you have to work in with, and that's kind of a pain. Borrowing against real estate is a lot of times very beneficial. I think that's kind of like one of the biggest value adds it can add to a portfolio, is just banks and traditional financial institution, large pools of capital, understand the asset class like intuitively, and so it tends to be easier to borrow against than a lot of other assets. And that's really kind of where we hone in on the most, is like, okay, we generally want some real estate exposure, especially if it's primary residence. Like that's all fine and dandy, but could we utilize that asset to stack more Bitcoin or give more flexibility to our Bitcoin portfolio?
I'm curious, why have you run the numbers when you add digital, what we call digital rents, these digital credit instruments issued by Strategy or now even Strive, and there's others coming online. I guess MetaPlanet is going to be releasing something in the US, but that can also service the debt, right? Because part of the issue is if you do a HELOC as like a second mortgage or something like that, you still have to pay the juice, and it's got to come from somewhere. So kind of how we think about it at Westmain is, if we kind of go half and half, we can pretty much carry our cost of capital and then basically extract the Bitcoin and the tax deductions. And so that becomes attractive and kind of goes along with what you're saying. Like, how do you stack more Bitcoin and do it in a responsible way that, you're not going to blow yourself up?
Certainly. No, it's a great question, Kenny. And that's one of the reasons I was super excited. Chris asked me to come on, because I'm just a general enjoyer of Bitcoin as finance. It's funny, ever since I met Chris, probably not too funny, he's a very charming guy, but my Bitcoin real estate network overlap has just exploded since then. I'm meeting a lot more of you folks, and I kind of put this in my general Bitcoinization of finance thesis, where it's like, how can we build the tools, products, and strategies to get dollars into Bitcoin? And you guys are obviously tapping the real estate asset class to do that. I love a lot of these creative metrics like Satoshi's per square foot. I think the more ways we can measure the performance of asset classes compared to Bitcoin or integrated with Bitcoin compared to their traditional counterpart, the better off we are. And so love what you guys are doing. I think it's really exciting. And Kenny, to your question specifically, so I'm working a little bit more, kind of more on the individual focus, and have come across more folks that are talking about the strategy you're actively deploying. So tip of the cap there. I think it's brilliant. But a lot of times Bitcoiners tend to be Bitcoin rich and cash poor, but still have dollar denominated liabilities. And so a lot of what we do, and my firm's set up like a little differently. It's like a la carte. So, just because I do a financial plan for clients doesn't mean I manage their assets. You have to like opt into both. But what I'm predominantly doing now is like, if we have a financial planning client, we do manage their portfolio. Like, we just have some firm level philosophies that we don't stray from. Like, as a Bitcoiner and a fiduciary, I can't in good faith put you in sovereign debt, right? Because you're just going to get paid back with printed money, and we don't actually get anywhere. And so if an individual has a need for fixed income, well, now we need to get like more creative. And it's been a lot easier on me since the development of STRC, since the development of SATA, to put clients, traditional capital market dollars into fixed income investments where the underlying exposure is Bitcoin. So we're staying true to our core beliefs and investment philosophies, but still kind of satisfying some of these TradFi itches. And so I certainly agree. A lot of times, like, okay, so we are taking out a HELOC or some sort of debt on our residential primary residence. How do we service that debt? Like, we're certainly utilizing more things like stretch and some of these preferred stocks. It just doesn't necessarily flow obviously the same way on like a personal balance sheet. And wouldn't necessarily categorize it as like digital rent like you guys do, whereas just kind of like some nuances between like the business balance sheet, but ultimately kind of like the same sort of philosophy.
Yeah, I can appreciate all that. I mean, it's kind of coming from the same vantage point. Wyatt, I know the digital credit conversation is very polarizing right now, but as a Bitcoiner ourselves, it's like if the Bitcoin foundational layer is kind of the first step, and then there's going to be things built on top of it. All of them are going to come with different risks and rewards. So just like you would anything else, you got to do your homework and understand the trade-offs. And I think that's what we're trying to do here with the commercial real estate space. Is we've all, Kenny and I've come to the conclusion, we've said it a lot. It's like real estate, residential or commercial for that matter, is not going to zero, right? It plays a valuable role in society, whether it's shelter, business, community, culturally, etc. But if you're operating from the standpoint that one, real estate always goes up over the long term, cap rates are going to stay in this 5 to 7% range for the next 30 years. Leases are going to be 5 to 10 years long, et cetera, et cetera. So you go down the kind of the checklist. If you're operating from that standpoint, that's an incredibly dangerous perspective to have. And if I'm a LP trying to decide, hey, am I going to give my hard-earned savings, my $100,000 investment, my $500,000 investment to which sponsor, right? I mean, that's you need to understand those those different philosophies and again the trade-offs. So if we compare Bitcoin and Bitcoin adjacent products with the tangible real estate, you're going to produce not only better returns, but you're going to make for a much more resilient real estate investment, right? Whether it's a single tenant or a multi-tenant, or if it's West Coast or East Coast, et cetera. And the cool part with what we're doing here and exploring like in real time is that every single property, right? Whether it's Westmain up in Rhode Island or some apartments in your neck of the woods in Denver, like the strategies that are applicable to Westmain aren't necessarily applicable to apartments in Denver, right? And so on and so forth. So there's a lot of creativity, there's a lot of flexibility, and there's a lot of different options that real estate investors, whether they're the sponsor or the LP, can deploy on any one particular project. Which, as a real estate professional myself, I love the creativity component. Because it's not just a one size fits all, just like I'm sure you get in your business every day as well.
Oh, absolutely. And this is where I actually have the most fun, is thinking of Bitcoin investment product design and how you can integrate Bitcoin into new investment products, or like what you guys are doing with kind of integrating into existing asset classes. So I love this idea of dual collateralized assets. I've studied Andrew Hohn's and his business model a lot. That's how I kind of first got attuned to this, and it was just one of those light bulb moments for me where it's like, wow, that's pretty brilliant. And when you start integrating Bitcoin into different investment products, whether it's real estate or he has like the Bit Bonds proposal, you really can start tweaking with. And I know financial engineering gets a bad rap, but to me it's like the most direct usage of the term is like what we're doing, because now we can start playing with like the risk return profile of multiple different asset classes, right? And now we can suit multiple different investor types. It's been kind of like the boogeyman for forever. CalPERS or X pension fund can't invest directly into Bitcoin, and so MSTR obviously got a ton of inflows in the early days because they can invest in common shares of equities, and it's indirect Bitcoin exposure. There are certain funds that have a real estate mandate that can't spend LPA dollars to purchase Bitcoin directly, but now they can own Bitcoin indirectly via a real estate investment that has Bitcoin on the balance sheet there. And so I think that's really exciting when you can really fine tune these investment opportunities, and you're a lot of times you may be de-risking the Bitcoin investment with the real estate exposure, or you may be juicing the real estate returns with the Bitcoin exposure. And so when you get creative with this kind of stuff, the opportunities are really endless. And when I try to play this out over a long period of time, something we talk a lot about is regardless of what industry you work in, I think you have the responsibility to build that industry within the principles, values, and ethos of Bitcoin. And I never want to forget what the cypherpunks did for us. Even though I wear a suit jacket, like I'm not discrediting their work. I'm not trying to make Bitcoin like all about the suits or whatever. But when I look in the future, and I firmly believe we'll live in a hyper Bitcoinized world, whether it's our lifetime or our children's lifetime, like I don't know, but that's a future I see coming. And it's like, well, how does that happen gracefully and peacefully? It's like, I think it happens via the finance industry and slowly integrating Bitcoin into different investment products, different asset classes. And over time, Bitcoin just overtakes them, right? And it's like, or, I agree, real estate's not going to zero, but, now I have Bitcoin exposure on top of my real estate exposure, or in combination with my real estate exposure. And that's how I think like we slowly orange pill the masses. And it's just something that starts niche over time, and then it gets mainstream, and it just happens in the background, and you don't even know. And then it's like one day we're just on a Bitcoin standard, but it was because it was integrated into financial products for, we're looking back 30 years or whatever.
Yeah, absolutely. I mean, every single industry needs Bitcoin. They just don't know it yet. And that was kind of the big unlock for me, was, trying to figure out how to get involved, how to help build out this ecosystem, this broader movement. And it's like, to your point, I'm not a software engineer. I can't code. I'm not, super technical person, but, I have expertise in real estate and, 15 years of experience and relationships. Like, there's value there. And whether it's real estate or healthcare or, law, financial, I mean, they all need Bitcoin. They just don't know it yet. So that's what we're doing here, is we're trying to further that mission and compress that 30-year timeline to, hopefully 10, 15. We'll see.
Well, I think you guys both hit on something important. It's like, all of us, I'm sure, like have been buying Bitcoin for a while, and then you get to a point where it's like, well, how do you buy more? It's like the Michael Saylor question. How do you keep buying Bitcoin, and if you're going to be taking on debt, I think that's where you have to do it in a responsible way. It's intelligent leverage, right? And that's kind of the big unlock with digital credit. It's monetizing Bitcoin, and we get to stand on the back of giants and use that to our advantage, and use that and build that into our businesses, right? So it's building Bitcoin as the core asset, and then as well as the digital credit, which it's all going to the Bitcoin network, right? It's all being used to purchase and store the time and energy in Bitcoin. It's just that there's different owners of that Bitcoin, right? And you're saying, well, this company, we know what they're going to do with it. They're going to be, issuing digital credit to buy Bitcoin. That passes the sniff test, right? It's a Bitcoin related product. It's built on Bitcoin, and you're doing it in order to extract even more. You're trying to refine your whatever business it is that you're in, and whatever cash flows that you work with. You're trying to maximize that. So it's not like in lieu of purchasing Bitcoin. It's like you're on the next level, and you're trying to extract even more Bitcoin. So this is a different bucket. This is a different goal here. It's not starting from zero, essentially. In most of these cases, it sounds like.
Absolutely. I think this might be a good place to just pause for a minute for a quick message, and we'll be right back. Quick note for property owners listening to the show. If today's discussion sparked questions about how these strategies might relate to your own building or portfolio, we're always happy to have a conversation. No sales pitch, just a thoughtful discussion about your property, your capital structure, and the options available in today's market. You can find our contact information in the show notes. All right. And we're back with Kenny Alves, Chris Drizga, and Wyatt O'Rourke. We're talking about cash flow. Where were we, Kenny?
I think we were just, reiterating that it's important to start off with raw Bitcoin. To get Bitcoin, buy it on an exchange, or however you're going to do it. If you're going to mine it, get it into a cold wallet. Start with the basics, and once you're scratching your head on like, how do I get more Bitcoin? That's what these conversations are about. So it's always good to just kind of reiterate the importance of having a stack of Bitcoin to begin with, and not doing this in lieu of just Bitcoin.
And Wyatt said something there important about financial engineering that I want to circle back to, because we've talked about it before, and I've been critical about just the over financial engineering in our space. I mean, it's incredible how people financially engineer these deals just to pencil, right, for a couple basis points here and there. And I think there's a difference between financial engineering and optimization. And what I mean by that is, we're not adding the Bitcoin, we're not adding digital rent, we're not doing any of these things to make a deal pencil, right? Like, we're underwriting the real estate deal on its own merits, right? Is the cash flow from the tenants enough to cover the operating expenses and the debt service? Is there anything left over, right? You don't have to overcomplicate that. If the answer is yes, okay, move to the next step in the process, right? And that next step in the process is, in our view, how the heck do I optimize this? How can I use the positive cash flow from this real estate asset to stack Bitcoin, to create additional income streams, to make the asset more resilient for market conditions and changes in tenant and consumer demand? So I wanted to kind of draw a distinction between those two, because I think it's incredibly important. And I think a lot of people have you alluded to it at the beginning there, Wyatt. There's just real estate has been such a favored investment vehicle for so long. And, with the monetary system that we live in, we don't have to go into those details. There's values are distorted, like dramatically, right? Whether it's residential or commercial. We focus on the commercial here, and it's like, yes, there's a utility value component to it, but the commercial properties are also, they garner a premium based off of, the tenant profile, the credit worthiness of the tenant. And now you're seeing in real time what AI can do to some of these, blue chip companies, right? I mean, commercial properties that have, software companies, SaaS companies in there as tenants, those things were trading for, massive premiums relative to, competitors in the marketplace because they were, the FANG stocks, right? And they were the 800-pound gorilla. Well, guess what, right? That 8-10-year lease that, occupied a whole building, that business model was just, one-shotted overnight by, Claude. You know what I mean? So how do you underwrite real estate credit, tenant credit? I mean, that's another big question we haven't even jumped into here, but it's bringing all these different questions to the forefront. And I just kind of think about, and I'm curious to get your experience too, Wyatt, is like when you're talking to a 30, 35, 40-year-old client, right? And they're saying, hey, I have the career, I have a growing family, I got the house, I kind of checked off all these boxes, and I'm getting to a point in life where, I'm building my investment portfolio, right? Maybe I want a little bit of real estate, I already have my Bitcoin, I want some precious metals, some stocks, whatever that combination thereof. Just looking at a vehicle or a product like STRK, right? Like why, if I have $100,000 to go throw into a deal, why would I throw that $100,000 into physical real estate when I can go put it into something like STRK, right? That has I think of STRK as digital real estate, just pure play, right? You have the $100 liquidation value is your land value, right? If the building burns down, at least I have that left over, right? I have my 8% quarterly distribution, great, cash flow, check. And then there's an appreciation component over, medium or long-term time horizon. I mean, if that's not real estate in the digital era, I don't know what is, right? So, and then it's got all these other, really attractive properties, right? The over collateralization, the liquidity profile, the tax treatment. Why the heck would I go buy real estate, physical real estate, as opposed to one of these products? I'm just kind of curious, like how you have that conversation with your clients, and when they come to you, what is going through their head? Are they even aware that these things exist?
Yeah, it's a great question, Chris. I would say, I have the benefit of working with some great Bitcoiners, people that, pretty in depth, or deep down the rabbit hole. A lot of my new clients, fairly sophisticated, worked with some sort of financial professional before. And a lot of times they've just jumped ship because, their existing advisors telling them to sell their Bitcoin, or they're laughing out of the room when they want to talk Bitcoin. I just tell them simply to come home, work with me. We speak the same language. Like I'll take care of you. But our high level investment thesis is, we're seeing this, return to real world, physical assets. And, I certainly, put Bitcoin in that category. I think the cat's out of the bag, obviously, with our debt situation and, the U.S. Treasuries. Like nobody wants to buy like these fake promises where they're getting debased. And, I really kind of think of the Genius Act as, petrodollar 3.0, 2.0, whatever you want to do. It's like the central bankers are very creative in drumming up artificial demand for U.S. Treasuries to keep the dance going. But that's all we believe it is like a blip in time, with stable coins, buying up treasuries. So when we kind of highlight, that and understanding our fiscal situation, like when we do a financial plan, we use 6%, inflation, because that's, average M2 money supply growth over the last 10 years. CPI is fake, manipulative statistic. And most folks, grok that, and most Bitcoiners grok that. My normie clients, it's some blank stares sometimes that we have to, work through and bring them up to speed. And so after we kind of have that, foundation, it's looking at the realm of investable assets, right? And so we already kind of talked about, bonds and why we don't think those are largely investable. Stocks, you brought up like the same AI concerns. I have, read an article the other day, the S&P 500 is the most concentrated it's ever been. We've had this proliferation of passive investing. Everybody just like blindly, puts money into, SPY or whatever. And so market cap weighted index, FANG keeps getting bigger, S&P 493 keep getting smaller. And so we have like this over concentration in a handful of companies. And it's like not super impressed with like the overall health of the stock market. And it's like, okay, well, then, we're moving to alternatives. And it's like, okay, if you're a credit investor wealthy enough to get access to venture capital deals or private equity deals, like, okay, it could be interesting. I think startup equity growth could, compound faster than, Bitcoin appreciation. But, there's a lot of due diligence and trade-offs like liquidity that come with those types of investments. And then, precious metals, again, I kind of view similarly as real estate. Like, I'm not a hater, falls into kind of our, return to real assets, kind of high level, thesis. Don't have to worry about, the AI disruption there. And so ultimately, we're kind of narrowing ourselves down to precious metals, real estate, and Bitcoin. And it's like, okay, to your point, I have dollars I may be willing to allocate to, one of those three asset classes. Like, how do we size those positions? And it's like, obviously everybody's different. Like, what is their existing, Bitcoin stack? Are we still in accumulation phase? Are we more in, I want to utilize my existing Bitcoin stack more? It's funny too, like I love my clients, but it's like they think they're diversified because they're 70% Bitcoin and 30% MSTR, so it's a little bit of a different conversation than most financial advisors are having. But we talk through, okay, you want to buy an investment property, in Denver, like Airbnbs in mountain towns are like, really popular. Okay, well, a lot of those local municipalities are restricting, Airbnb usage. Like, could you even use Airbnb? Okay, you're not using Airbnb, then it's like, do you want to be a landlord? Like, do you want to fix like a water heater that goes out after you're paying like your mortgage nut and everything goes fine? Obviously with higher interest rates and, higher property values out here anyway, it's like, are you profiting $100 a month, $150 a month to, do that? And so ultimately, like, Bitcoin kind of ends up being kind of like our pseudo, default investment. And that's obviously kind of what we end up gravitating to when we're evaluating the realm of investable assets. But that's kind of more on a personal balance sheet level, where I really think like you guys have cracked the nut is kind of on the larger institutional pools of capital that have like a lot bigger, checks to write. And I think they need to be specifically tuned in. You kind of alluded to this earlier, Chris, on like the risk profile of what they're investing in, because they're faced with like the same, investable option, conundrum that the individual is. But, they have this responsibility to investors, and they're dealing with, other people's money. So they have to also take on that risk. And that's where I really think like integrating Bitcoin into other asset classes is the big unlock, because you just de-risk potentially, a huge part of a potential deal for them. Or they can just take like a longer, time horizon to that deal. And it's like, okay, this is probably 6 months ago, but to your point, there was a big office building in downtown Denver that was bought 10 years ago or whatever for like $100 million, and it sold for like $4 million, right? So it's like, okay, that potentially is a risky deal, but if I can go into it with a 10-year long time horizon as opposed to a 5-year or whatever, I've been forced into it without incorporating, Bitcoin into the deal, it's like, does that open up the realm of investable assets? Because I have large pools of capital I need to deploy. Obviously, if I'm just sitting in dollars, that wealth is, rotting away. I have investors. I have a legal and moral obligation too. And so those are the folks that I think need to get like the most creative with their investment strategies. Or it's like, fortunately, a lot of times individuals, can benefit from just buying, spot Bitcoin and then, tweaking, their personal allocations between tapping, that idle home equity or whatever it may be.
I'm glad you brought up the Denver office building example, because that is one of many. I mean, the average Joe that's not, living and breathing this stuff like we are every day has no clue the scale of distress that's taking place across the country. There are dozens of those examples in every single MSA in the entire country. 95 to 99% discounts, over the last trade, right? Not even the all-time high. And they're just being, they're people say, well, why isn't it showing up in the data? Why isn't it showing up in the marketplace? Well, there's a few reasons, but high level, they're all baked into they're all, stuffed into these pension funds and these private equity deals, and they're getting papered over, and, people don't realize it, right? And it's just, as a Bitcoiner, it's building that fragility in the marketplace the longer that this goes on, right? So, there's going to come a day where the crows come home to roost, and it's just going to be that much, that much more violent when it actually does. So yeah, I appreciate you saying that. And I think, you hit on another, as a Bitcoiner, the whole time preference thing, right? You have the ability to think long-term, be intentional and methodical about your decision-making process when, Bitcoin is your hurdle rate, right? And one thing we've been pounding our fists on the table here at the Real Estate Standard is that, there's 3 buckets of capital, right? Or three potential buckets, right? You have Bitcoin, you have digital credit, you have real estate. And, the highest and best use of capital, in our opinion, is to accumulate as much Bitcoin as you possibly can. The second best use is to establish a digital credit position for the income stream, the collateral, the liquidity components that come along with that, and sit back and wait, right? Because there's not enough distress in the real estate markets to justify, going head first at that 10-year, at that deal, right? Even if it is a 10+ year hold, there's just not enough dislocation in the marketplace to have confidence that, hey, I'm buying this thing right? Because, that premium in real estate, that store value premium, is just beginning to leak. I think that might even be a little, a little bit of an exaggeration, right? Has it even begun to leak is probably what most people would say. So if I know that, hey, there's 30 to 40% of this value that, could potentially leak into Bitcoin over the next 20 years, into digital credit over the next 20 years, am I really going to go buy that property at a 20% discount to fair market value?
Totally.
Well, oh God, I was going to add something before you answer.
Yeah.
Because one thing that we kind of haven't really touched on really much is tax planning. And I know that's like for CPAs and accountants, but I'm wondering how closely you work with these CPAs and accountants, and how many of your clients being Bitcoiners, I'm thinking that they don't like paying taxes. They probably want to end the Fed, and they want, like, seriously, my goal is to pay as few taxes as possible. And the reason, I got involved in solar was mainly for the federal tax credit. And the reason I am a big fan of digital rents, digital credit, is because of the deferred tax component. And I'm sure the reason, these guys that you work with are thinking of real estate because they want depreciation and they want the tax advantages of that. So I'm just wondering, like, how does the tax component kind of fit into your role? And do you work with other professionals and have like meetings with them and your client and work through these things, and just kind of the goal on from a tax point of view?
Yeah, it's a great question, Kenny. And we do, so I'm a financial professional, licensed to, operate in that realm. And it's always like this song and dance you got to play with clients, because obviously, like, the finance world and tax world and the legal world, like, especially when you're putting, elaborate plans together, like, they're all butting up against each other. And, it kind of sucks. And this is actually, something I've done a lot of work on lately. And so, I can advise a client on, it's like, well, what are the tax ramifications going to be of putting money into like a Roth IRA versus a traditional IRA? So there's like some nuance there, we can advise on, and that's certainly, a big part of our financial planning is making sure we're in the most tax advantageous, position possible when it comes to kind of like your financial decisions and keeping that in mind. But it's funny you brought that up, because we actually soft launched this at the Bitcoin conference, but we actually started the Bitcoin Family Office Group. And that's kind of like a quarterbacking entity that is meant to serve high net worth Bitcoin individuals. And a lot of times, like, their experience is like, okay, I'm talking to my financial advisor. He doesn't understand Bitcoin, but we put this plan together. I'm a Bitcoiner. I know I should get a trust to make sure, my heirs and my beneficiaries remain private, upon my death. And I hope my CPA understands Bitcoin and how all these things play together. So you're having all these disjointed conversations, hoping and praying your existing financial or service professionals understand Bitcoin, but they're more than likely not talking to each other. And so what we did is, we have this quarterbacking entity, and then 5 Bitcoin native firms working together behind the scenes to give our clients the best possible advice and outcomes and overall client experience. So I handle the finance side of things. Satoshi Petroli handles the tax side of things. Falcon Rappaport and Berkman handle the legal side of things. We have Abundant Minds, because obviously, like, the mining tax play depreciation is very popular right now. Bitcoin well and acquisition, and so we're able to work together and provide like this unified front of Bitcoin native service professionals that understand the asset class intuitively, built our practices around it, and offer you like the best form of advice possible. And that way, we're not dancing around like, well, talk to your CPA, not my job, and it's like, it's not great to hear from, a client's perspective. And so we are working to solve that, understanding, our license and regulations do kind of, box us in a little bit. But overall, to your point, that's why I think, like, dual collateralized assets are, brilliant. So if you have a real estate investment with like, a part of the, an asset class that you can depreciate, on top of Bitcoin, it's like, it just to, your previous point, Chris, can really unlock like that, creativity that I think a lot of, financial professionals have over the last 30, 40 years with this rise of passive investing have felt like it's not their responsibility to take on. And so that's where I think we're all going to be kind of in an advantageous position of taking it upon ourselves to build these new investment products. To your point earlier, though, Chris, about kind of this mismatch of values in the real estate market, that's actually kind of one of my dark horse hot takes. Is everybody talks about this generational wealth transfer from boomers to younger generations. I think that's largely going to be fake, or not all it's hyped up to be, because most Americans, like, their wealth is stored in their primary residence. And I always chuckle a little bit to myself and then get pissed off and have to cool down in the car before I get home. But I have like some older clients. It's like, one specifically in Texas bought their home in the mid 90s for like $85K, and now it's worth $500,000. It's like, what? Okay, you can't tell me the utility value of your home increased. It probably went down because you got to replace a roof, you got to put new windows in, like whatever it may be. But we have like this massive monetary premium valuation. So it's like, okay, I'm starting a family. I currently rent because I don't want to part with my Bitcoin, but I am in the market, theoretically, to purchase a home. But as somebody who's denominated their life in sound money and a hard asset, when I go to trade that hard asset for another hard asset, I am smacked in the face with like a value for value, decision to make. And I know that home you're trying to sell me is not worth the $500,000, it currently is. So I'm just waiting patiently, stacking sats, staying humble, being a good Bitcoiner, because ultimately when those assets go to trade, they have to sell it to somebody that's willing to pay what they think it is worth. And, clearly I'm kind of taking the position where it's like, no, sorry, I don't think that home's worth $500,000. I'm not going to pay it. And so ultimately when those assets do go to trade, I think there will be, a lot of forced sellers in kind of like that boomer class that, have end of life expenses, or they pass away, and like their children or whatever are left with this home, and likely kind of given like the generational differences, they probably don't even live in the same area as their parents. And so I have a house in Albuquerque, New Mexico. I don't live there anymore. I just want this off my plate. I'll take whatever you'll give it to me. And so I think that would kind of largely, at least in residential real estate, drive home prices back down. And that's how I'm kind of thinking of the residential real estate asset class.
I agree with you 100%. As far as like the greatest wealth transfer conversation, like I just don't think there's going to be anyone on the buy side that's willing to pay it a number that's even relatively close to what their expectations are, right? So to your point, it may take a little longer to play out, but there's ultimately going to be some sort of life event that forces their hand, and that's how the repricing will happen. I think out of all the asset classes over the next call it decade or so, real estate faces the biggest repricing risk for all the things we've covered here today. To your point, this may actually help you and your team with some of these clients too on the real estate side. But if you haven't caught it yet, I think it was last summer, the team over at Horizon, Joe Consorti at Horizon, they put out a research report. It was the best one and one of the few that I've seen attempt to quantify what that store value premium is in real estate. And it goes through a couple different approaches, shares all the metrics, all the underlying assumptions, and very digestible, very understandable for the average person. And the long and short of it is there's somewhere between, depending on the assumptions you use, it's the premium that's baked into real estate is somewhere between 33 and 38% was what the takeaway from that report was. And being a real estate person, I think that's really low. I'd say you're probably in that 33 to probably up to 50 percentile range, depending on the specific situation that you're talking about. But if you haven't already, download that on their website, or I can send it to you when we get offline here. But really, really good piece that kind of substantiates what we're talking about here.
No, thank you for that. I did not read that. I'll have to check that out. Sounds fascinating. Love Joe. I think they got a great team over there. I think they're doing something cool.
Yeah, I agree. And it's I'm running the same boat. I don't know about you, Kenny, or you, Tim, but a lot of my friends, a lot of the my peers think I'm crazy, for renting a home and not wanting to, or even having plans to buy one anytime soon. If you can get something at the right price, you kind of look at today's build quality, right? The labor, the materials, the finishes, just the overall quality of the craftsmanship or lack thereof. And it's complete garbage, right? So, unless you're, building a custom home and you have complete control over every, aspect of the process, or you're buying, an older home, 70s, 80s, early 90s vintage, those homes were built properly, and they're very easy to tell the differences when you walk into it. It may not have all the, shiny, fancy new finishes, but the overall quality and durability is there, and it's only a matter of time before they, separate themselves. So that's my personal perspective as well. So you're not alone.
Well, that's good. I'm happy to hear that. Yeah, dude. And it was funny. We've been at our place for a couple of years now, but we were touring. It's like our home was built in like 1948. Like, it's actual just brick. It's like, yeah. Even now, like the new houses I see built in my neighborhood, it's like a brick facade. It's fake brick. It's like, are you kidding me? Like, that's so BS. And then, it's kind of option to like, older single family home or like, brand new townhome. And then we walk in these townhomes and it's just like, this is glue and plastic.
Yeah. Yep. And I just recently found out that one of the tricks of the trade was, the less angles and the less lines, the cheaper the build, right? So you think of like the big craze right now is these open floor plans, right? The entertaining, layout, right? I love to, be a party host. Well, that was a roundabout way of saying, hey, I'm going to cut my construction costs by a couple percentage points.
Well, I'm happy you brought that up, because when I get on my philosophical high horse, my second favorite Bitcoin real estate folks after the real estate standard, of course, is, I think his name is Austin. It's either Trummel or Trunnell or
Tunnel.
Tunnel. Okay, yeah,
Yeah.
in Oklahoma City, and like it's so funny to me, yeah, because that's exactly right. Like these townhomes, like just straight lines, gray, super boring. Like our home actually has like some built-in shelves. I was like, wow, who would have thought built-in shelves? But it actually just adds, like, like a nice like catch of the eye. It's like more attractive, and I think like Bitcoin is a noble cause, and we should embrace that. That's what I really kind of am getting at when I was mentioned earlier, that whatever you're doing, do it within the principles, values, and ethos of Bitcoin. And what I love that those guys are doing by being Bitcoiners, integrating Bitcoin into their practice, like they're just building good stuff, and they're building beautiful things. And by, expanding that time horizon, denominating, your profit and loss statement or your balance sheet in a hard asset, in a sound money, we can actually bring back nobility. We can bring back beauty. And these are all things like we drastically need. You drive around Denver and it's like every corner is just some 5x1 that's been thrown up in like 2 weeks, and it looks awful. And it's like, okay, what are we doing here?
Yeah, I think the project you're talking about, the Townsend project outside of Oklahoma City, and it's all high quality craftsmanship. They're using stone. They're using quality materials that last for 100 years, I think, is their tagline, or their tagline. So if you haven't seen that, Google them, pull them up on X, Austin Tunnel. They're doing a really, really exciting stuff out there. So I think that's all I got for you guys today. You got any closing thoughts, Kenny or Tim or Wyatt?
Yeah, I guess I'll comment. You guys reminded me the choices I made and have to live with. In 2020, I went, the vintage route, and been working on that ever since. But I always make the joke, I could have chose to live on Skid Row for 5 years and just waited it out on Skid Row or something like that. But you gotta kind of draw the line, and you gotta live a little. So we found a house that works for us, and we've been fixing it up. But I would agree, the newer houses, you want to probably stay away from most of them, because the construction quality is very poor. And you always want to like think of where you're buying. Like we kind of found a home in a great area, and we were lucky that it appreciated a lot after we bought it. Not as much as Bitcoin. I'm always reminded by that when we talk about that. But we couldn't live in our Bitcoin back then. I know Horizon makes it possible, and some of these other guys make it possible to kind of live in your Bitcoin, so to speak. But that wasn't a tool available for me. But it's a sore subject. Let's just put it that way.
Well, don't beat yourself up, Kenny. I'm sure you're sitting on a nice interest rate, and you did the best thing you could for your family.
Yeah, 2.78%. So and then I did a second mortgage and got a HELOC. We've actually borrowed more money than the purchase price of the house. So that's just showing you how, if you use the leverage intelligently, you could use it to buy back the Bitcoin, and maybe you're not going to get as much Bitcoin, but it's a happy kind of medium.
Certainly. And actually that is one thing I just kind of my closing thoughts here, that I'm happy you included on your dashboard, was like that LTV monitor, indicator, because I have a lot of folks approaching me. I think Mark Moss, which I'm a fan of, I think I like what he's doing, but they're interested in, like, I think he calls it like build, borrow, die, or something like that, like his little moniker there, and about using Bitcoin collateralized loans and stacking more Bitcoin and stuff. And I'm not as like morally opposed to debt as a lot of people. I view it as a tool. Understand that touchy subject with people, but we actually built our own Bitcoin backed loan calculator at Basilic Financial, which is essentially just like Mark's thoughts from like a financial advisor's perspective, because I think if there is not even error, that's the wrong word, but I think he gets a little bombastic in his marketing sometimes. And so that's something like we really hone in and focus on. There's a lot of interest, utilizing these tools from Bitcoiners. That's great, but let's make sure we're going about it smartly. So we take a lot of time getting into it's like, well, how much of your stack is actually being utilized? Where's that Bitcoin custody? Do you have a good, counterparty? Can you trust this? Is other cool lending products, or non-custodial? So just doing due diligence on the providers, but ultimately just being, to your point, Kenny, just smart and intelligent about using leverage if you decide this is a tool you want to take advantage of.
Yeah, that might be a whole nother episode, comparing the mining versus the digital rents, because they're doing it for the accelerated depreciation to write off the full cost of the equipment. But if you look at incentives, like if you're like hunting for tax incentives, nothing beats the return of capital structure. That is like the creme de la crop, where accelerated depreciation is a few bars below it. So I'd love to talk about that again sometime. Maybe we'll do a X Spaces and you can join us and we'll get everybody's thoughts on the differences there.
I was with the work we've been doing here the last few weeks, Kenny, with the cash out refi and the tax-free proceeds from that and the STRC dividends, all of it. I mean, real estate's already really tax advantaged, right? And now you add in the way Bitcoin's classified as property and the ROC dividends as well. Like, what if you dropped one of these properties in an opportunity zone somewhere across the country? Right, there's tons of them, and for those of you that aren't familiar, an opportunity zone is basically a special designated area that the government wants to revitalize. So they provide various tax incentives over specific time horizons. I think it's a 7 to 10 year time horizon, to incentivize the capital going to those places. So it'd be interesting to see how tax efficient could you actually get, between the opportunity zones, just the real estate profile itself, the return of capital dividends. I mean, you could really go crazy to the next level on your tax efficiency.
That's right up my alley. We'll have to save it for another time.
All right. Well, thanks everyone for listening and watching to the episode and a half of episode 21 of the Real Estate Standard Podcast. Thanks, Wyatt, for joining us. If this conversation was useful, please share it with someone. Share it with a partner, a client, somebody making decisions in the marketplace. New episodes drop weekly on the Real Estate Standard handle on X and YouTube. Until next time, stay disciplined, think long-term, and stack sats. For Kenny Alves, Wyatt O'Rourke, Chris Drizga, I'm Tim Kotzman. This is the Real Estate Standard. If you enjoyed today's conversation and you own commercial real estate, we'd encourage you to think about how these broader shifts might impact your own property over the next decade. Many owners are starting to reconsider how they structure their balance sheets, manage capital, and position their assets for the future. If you'd like to explore how some of these ideas might apply to your own situation, you're welcome to reach out. We work with property owners and investors to think through strategy, structure, and long-term positioning in a rapidly changing market. You can find our contact information in the show notes.